Mr. Chairman, if the economy were to accelerate, the Fed would have to start unwinding QE3. So what is the Fed's exit strategy, the steps it will undertake, and when do you anticipate to begin executing this?
Mr. Chairman, so first, the first thing, of course, would be to wind down eventually the quantitative easing program, the asset purchases. As I've said, the program relates the flow of asset purchases to the economic outlook. As the economic outlook, and particularly the outlook for the labor market, improves in a real and sustainable way, the committee will gradually reduce the flow of purchases. I want to be very clear that a step to reduce the flow of purchases would not be an automatic, mechanistic process of ending the program. Rather, any change in the flow of purchases would depend on the incoming data and our assessment of how the labor market and inflation are evolving. So at some point, of course, we will end the asset purchase program. Subsequent to that, we will follow the guidance that we have provided about interest rates. Our principal tool for raising interest rates will be the interest rate on excess reserves that we pay, which will induce higher money market rates and the higher federal funds rate. And we will complement that with other tools, including tools that we have for draining reserves. We may or may not sell assets. At this point, it does not appear that it is necessary for us to sell any assets, or particularly not any mortgage-backed securities, in order to exit in a way that doesn't endanger price stability. So there are a number of steps. We are currently discussing further our exit strategy, and we hope to provide more information going forward. But we certainly are confident that we can exit over time in a way that will be consistent with our policy objectives.
Do you anticipate allowing maturing securities to roll off the balance sheet before you begin selling securities themselves?
As I said, we could normalize policy by simply letting securities roll off. And I think there's some advantages to doing that. For one, it wouldn't disrupt markets so much. It would avoid as much irregularity in our fiscal payments to the Treasury. But we will see. Ultimately, in the very long run, I think there's a desire to get back to a predominantly Treasury security portfolio. But again, in the exit process, allowing assets to roll off would be sufficient to bring us to a more normal balance sheet within a reasonable period.
When do you expect this strategy to begin? What are the benchmarks you're looking at to begin this process?
We are looking at, we're trying to make an assessment of whether or not we have seen real and sustainable progress in the labor market outlook. And this is a judgment that the committee will have to make. If we see continued improvement and we have confidence that that is going to be sustained, then we could, in the next few meetings, we could take a step down in our pace of purchases. Again, if we do that, it would not mean that we are automatically aiming towards a complete wind down. Rather, we would be looking beyond that to seeing how the economy evolves, and we could either raise or lower our pace of purchases going forward. Again, that is dependent on the data. If the outlook for the labor market improves and we are convinced that that is sustainable, we will respond to that. If the recovery were to falter, if inflation were to fall further, and we felt that the current level of monetary accommodation was still appropriate, then we would delay that process.
At the pace we're going, do you think it's likely these actions will begin before Labor Day?
I don't know. It's going to depend on the data. The key to this program, in our previous quantitative easing programs, we gave a total amount of expected purchases, and when that total amount was done, we stopped. And in some cases, that stopping was premature because the economy was not yet on a fully self-sustaining trajectory. So the difference in this program is that we are buying a flow rate. We're buying a certain amount of assets each month, and the amount that we purchase will depend on how the data come in and how the outlook for the labor market goes over time.
How much notice will you give the market before you start executing the strategy?
Well, we've explained the strategy, and again, the market can see the data as well as we can, and what we are looking for is increased confidence that the labor market is improving and that that improvement is sustainable. And as we see that, we will, in steps, respond to that by reducing the amount of accommodation in a way that's appropriate and maintains appropriate level of accommodation given the economic outlook.
It's frustrating. Here we are nearly 4 years after the recession ended, and this economy is in such a weak state, a fragile state. At this point, the patient ought to be out of the hospital, done with rehab, and playing baseball with its kids. Feel like the economy's in the outpatient room, and the Fed continues to feed it medicine on a daily basis, asking, are you getting better? But my worry is that the Fed doesn't have the prescription for what ails our economy. A year ago, the Fed made clear that it wouldn't set an employment target rate because it's generally affected by non-monetary factors. But your unwinding of QE is based on the employment areas that you have the least control of. What do we make of that?
Mr. Chairman, first of all, the slowness of the recovery can be explained by a number of important headwinds, including the after effects of the financial crisis, developments in Europe, the problems with the housing market, and very importantly, the fact that fiscal policy for the last few years has actually been a significant headwind to recovery rather than a supporting tailwind. So I would submit that without monetary policy's aggressive actions, that this recovery would be much weaker than it has been. And indeed, if you compare our recovery to that of Europe and other advanced industrial economies, it looks relatively good. With respect to employment, the monetary policy, as a general rule, cannot influence the long-run level of employment or unemployment, and that's certainly correct. What we are trying to address here is the short-run cyclical gap. We are seeing currently the economy operating at a level below what it is capable of operating at, and many people out of work who normally would have work, and monetary policy can help to put people back to work in the short run. In the longer run, increasing the potential growth of the economy, as you mentioned earlier, that's not really the Fed's job. That's the private sector's job and Congress's job in terms of things like the tax code, investment in infrastructure, training, all those things that help create more growth potential.
And I will just thank you. I'll conclude with just the point. I think monetary policy has limits. I think QE, quantitative easing, has run its course. I've yet to meet a business who tells me if those lower long-term rates were just lower and there was more liquidity, I'd be hiring more. That's just not happening. It really is fiscal issues from higher tax increases, regulation extraordinarily, I think, burdensome to them. The President's new health care law is creating a great deal of uncertainty and impact on job hiring today. Those, I think, are the main roadblocks. That's why I think the earlier the Fed can begin communicating and announcing its winding, I think the more onus is put on Congress and the White House to actually address some of these critical fiscal issues. With that, I recognize Vice Chairman Klobuchar.
Thank you very much.